Okay.
Yeah. So with your permission, I am starting this session. Good morning. On behalf of CI, I welcome you all to the CI Conference on Financial Reporting and Governance Framework. This is the fourth and the validity session of the conference with the theme Role of Regulators and the Future of Audit. It is my honor and privilege to introduce the distinguished panels we have today. Shri Rangachari Sridharan, Chairperson, National Financial Reporting Authority. Sir, a very warm welcome, and we are indeed grateful to you for your kind presence today. Just to give a brief, Shri R. Sridharan has been the chairperson of National Financial Reporting Authority since 1st October 2018. Shri Sridharan has obtained an MBA from IIM Ahmedabad, also a MSc degree in Development Studies from University of Bath, England. He is also a member of the Institute of Cost Accountants of India and also Institute of Company Secretaries of India. Shri Sridharan joined the Indian Administrative Services in Karnataka cadre in 1983 and served in various capacities both in the government of Karnataka and the government of India. In his last posting before superannuation from IAS in 2017, Shri Sridharan was Secretary to the Government of India and Member Finance of the Space and Atomic Energy Commissions. It is an honor to have you, sir, in today's conference as chief guest, and we look forward to your address. We also have with us Mr. Shailesh Haribhakti. Mr. Haribhakti is a chartered and cost accountant, certified internal auditor, certified financial planner, fraud examiner, and also a board chairman, audit committee chairperson, and an independent director at some of the country's most eminent organizations. We have also Mr. P.R. Ramesh. Mr. Ramesh was former chairman of Deloitte India and a former member of Deloitte Global Board and is a fellow member of the Institute of Chartered Accountants of India. Mr. Ramesh is also an independent director on many reputed boards. We'll also have Mr. Harinderjeet Singh. Mr. Singh is Chairman, CI Subgroup on Companies Act, SEBI LODR regulations, and also partner PwCA LLP. Welcome and thank you all for your time today. Sir, we have 1000 plus delegates joining this session today and keen to listen to your address, sir. I must say, together among the panel present here, we have a combined experience and wisdom of around 200 plus years with us, and it would be a privilege to listen to these experts. As the theme of this session is role of regulators and the future of audit, I am sure we will have a crystal gazing and future forecasting towards betterment of the audit practice and audit profession in the country. With these words, I welcome you all once again and now straight away hand over and request Mr. Shailesh Haribhakti for his remarks and for moderating the session, please. Thank you.
Thank you very much, Vikas. Let me also extend my personal, very warm welcome to you, sir. So you have exemplified the finest in regulatory processes for our country. We therefore can now think of regulation as being symbiotic. We innovate, we put before you new practices, and you keep raising the bar. And I think it is this symbiotic relationship that you have given tremendous wing to during your tenure. We are all aware that everything is getting automated, token-driven, converted from physical to digital reality, democratized in every which way, particularly in the sphere of governance. It has become input that the auditing profession is providing to governance. With us today in our daily vocabulary is blockchain, digitalization, the multiplexing of internal and external data, quantum computing, making sure that we understand what algos can do for us and how that can completely take us forward in our digital journey as auditors and as people who provide the assurance on any communication that goes out to the shareholding public in India and externally. It is, sir, a great contribution from your side that has led India to become the best performing capital market of the world for the last 2 years. If you take a start date in 2020 and build up to today, we are the best performing capital market. And no small contribution in that is to the combined efforts of all the regulatory, legal, auditing, accounting profession that we practice here. The pillars that we build on are trust, privacy, transparency, and accountability. And so we are looking forward to listening to you and taking away thoughts and messages from your wisdom on what can be the next steps and the next evolution that we in the auditing profession may look forward to. Over to you, sir. We are keenly looking forward to listening to you. Thank you very much.
Thank you very much, Mr. Haribharti, for the kind words. Once again, to check with you, are you able to hear me clearly?
Yes, sir.
Okay, right. I'm very thankful to CII for having invited me to this financial reporting conference and asking me to speak on the role of regulators and the future of audit. I view it as an opportunity to share my experiences and thoughts on the subject as we come to the conclusion of the first term of 3 years of the NFRA. NFRA is the newest body to enter the arena of financial reporting and audit regulation. It is therefore natural that matters such as what exactly is the role of NFRA, what its functions and powers are, what it has done in the almost 3-year period since it was set up, and what its plans for the future are, would most likely be still unclear to many. A brief summary of these matters, therefore, appears to be in order as the first item for me. In addition, I wish to cover the following 5 subjects in this talk. The first is standards and the standard setting framework. The second is independent standalone audit as a viable business model. Third is the financial reporting ecosystem. The fourth is about capacity building of the NFRA itself. And the fifth would be about the future of accounting and auditing. Let me start with what the law says about the NFRA. NFRA is a creation of Section 132 of the Companies Act 2013. Though the section was enacted with the rest of the Act in 2013, it was finally notified only in 2018 after the PNB scam came to light. NFRA's functions are laid down by subsection 2 of Section 132 as covering A. The making of recommendations to the central government on the formulation and laying down of accounting and auditing policies and standards for adoption by companies or their auditors. Accounting and auditing standards are now prescribed by rules made under the Act by the central government based on the recommendations of the ICAI in consultation with and after examination of the recommendations of the NFRA. B. Monitoring and enforcing compliance with accounting and auditing standards in such manner as may be prescribed. C. Overseeing the quality of service of the professions associated with ensuring compliance with such standards and suggesting measures required for improvement in the quality of services. And D. Performing such other functions relating to clauses A, B, and C as described above as may be prescribed. The central government has notified the NFRA Rules 2018 using its powers under this section. Rule 4, which is important for us, lays down that the NFRA shall protect the public interest and the interests of investors, creditors, and others associated with the companies or bodies corporate under NFRA's purview by establishing high standards of accounting and auditing and exercising effective oversight of accounting functions performed by the companies and bodies corporate and auditing functions performed by auditors. In addition, subsection 4 of section 132 vests NFRA with the power to investigate professional misconduct by any auditor of any of these companies. When such misconduct is proved, NFRA is empowered to impose monetary penalties up to 10 times the fees received, and also to bar the auditor from being appointed as auditor or internal auditor of any company or body corporate for up to 10 years. In order to remove any chance of regulatory overlap, the said subsection very unambiguously provides that where the NFRA has initiated an investigation, no other institute or body shall initiate or continue any proceedings in such matters of misconduct. So what does all this do to define the character of the NFRA? It has become common to describe NFRA as an independent audit regulator. Audit regulation is indeed a very important part of NFRA's role definition, but this does not exhaust the entire definition. Rule 4 that I read out earlier requires NFRA to monitor the entire financial reporting chain. Indeed, the coherence and integrity of NFRA's objective will be meaningfully achieved only if corporate financial reporting in its entirety is treated as being its legitimate remit. And right from its inception, NFRA has been proceeding with its work program only on the basis of this understanding. Very early on, NFRA adopted a charter for itself to govern what it will do and how it will go about doing it. This charter, which is available on our website, reads as follows. The objective of the NFRA is to continuously improve the quality of all corporate financial reporting in India. The quality of corporate financial reporting will be measured and evaluated essentially by its compliance with the law and the statutorily notified accounting standards and auditing standards. NFRA will strive for continuous improvement of corporate financial reporting across all types of public interest entities, or PIEs as we know them, and across all size categories of audit firms. NFRA aims to be an organization noted for integrity, industry, and competence. Persons who work for NFRA will adhere to the highest standards of uncompromising integrity, possess a vision of transforming the quality of corporate financial reporting, and display high levels of initiative and an unflagging drive for their work. NFRA aspires to be known for objectivity, no subjective action from either members of staff, openness, either members or staff, openness to all facts, views, opinions without any preconceived conclusions or prejudging any matter. Integrity across cases, persons, firms, absence of multiple standards, uniform treatment of all those identically or similarly placed. Impartiality, discharge of its functions without fear or favor. Independence, equidistant from all stakeholders. Fairness, not imposing unfair burdens, especially with the benefit of hindsight. Transparency, fair and open processes. NFRA's functioning will at all times be mindful of the need to promote the ease and speed of doing business and will be guided always by the overall public interest, with all its actions being strictly anchored by and lying within its legal mandate. So what exactly is the domain of NFRA? Rule 3 of the rules specifies what classes of companies would fall under the purview of NFRA. Other rules lay down what procedures should be followed in discharging the functions specified in the Act, some details about the internal administration of the NFRA, etc. NFRA's jurisdiction covers what has come to be known as public interest entities. These are all listed companies, unlisted public limited companies with either turnover or share capital or borrowings above certain specified thresholds, all banking, insurance, and electricity generation and supply companies, foreign subsidiaries of these entities of a certain size, etc. In addition, the central government can make a reference to the NFRA in respect of, for action in respect of any other company or class of companies in the public interest. The total number of companies that come under NFRA's jurisdiction based on the criteria and the rules is quite large. As of 31st March 2019, we have identified 6465, that is 6,465 such companies. Of these, 5,356 are listed companies, 1,011 are unlisted companies satisfying the prescribed threshold criteria, and 98 are banking, insurance, and electricity companies. The audited profile of these listed companies is equally diverse. NFRA has been able to obtain the names of auditors in respect of 5,023 out of the total of 5,356 companies. There is a total of 2,304 auditors who audit these 5,023 companies. Of these, 1,578 auditors audit only one company each. At the other end, there are two individual firms that audit more than 100 companies each. The network firms of the Big Four account for 522 companies and 75% of the market capitalization. It is interesting to note that in 2017, there were a total of 1925 audit firms registered with the PCAOB of the US, of which 1390 did not issue any audit reports. The PCAOB had to effectively, therefore, deal with only 535 audit firms. The listed companies are also exceedingly diverse in size. AMFI, the Association of Mutual Funds of India, periodically publishes a classification of listed companies into large cap, medium cap, and small cap. The top 100 companies are classified as large cap. The market cap of this category is from 13.46 lakh crores. This is, I am talking of the average for January to June 21, down to 37,746 crores. The next 150 companies are mid cap. Their market cap goes from 36,954 crores down all the way to 11,819 crores. The remaining are small cap, with their market cap going from 11,735 crores to as low as 0.02 crores, that is 2 lakhs at the very end. As many as 1860 companies out of 5059 in the AMFI list have a market cap below 10 crores. The number below rupees 100 crores is 3276. The great diversity amongst listed companies perhaps is indicative of the need to define PIEs in a more restricted manner. Would it be really possible to have an effective audit company for the smallest listed companies is also one question we need to ask. I'll now take you back a little in time to explain how the NFRA came about to be. As I explained earlier, NFRA is also what is called globally as an independent audit regulator, or IAR for short. All of you, I'm sure, are fully aware of the events that rocked the audit and accounting profession around the turn of the century. The USA then saw the collapse of Enron and WorldCom, and also of Arthur Andersen, who audited the two companies within a short span of time. The consensus then was that a fundamental reform of the manner in which accounting and auditing were conducted and regulated had to be brought about. This resulted in the US Congress enacting what is known as the Sarbanes-Oxley Act, or SOX for short. SOX provided for the setting up of the Public Company Accounting Oversight Board, PCAOB for short, and for strengthening auditor independence. It also provided for increased corporate responsibility for financial reports, enhanced financial disclosures by companies, corporate and criminal fraud accountability, enhanced penalties for white-collar crimes, etc. Clearly, the leitmotif of SOX is the protection of investors, and the entire architecture of institutional reform that SOX brings about is designed to achieve this end. The PCAOB commenced in 2002 and has in many ways been a trailblazer and exemplar in this area. We also need to keep in mind that SOX brought about major changes in corporate responsibility for financial reporting, the enforcement of which is largely with the SEC. In a recent speech on PCAOB 3.0, the evolving role of investor protection at the PCAOB, J. Robert Brown, who was then a member of the PCAOB, has said that, and I quote, "The PCAOB is an almost 2 decades experiment in the oversight of the audit profession by an independent regulatory organization. Before 2003, the audit profession was subject to self-regulation, a time when standards were written by practicing auditors without adequate public input, and inspections were conducted by peer audit firms, a practice subject to extensive criticism. The creation of the PCAOB ended the era of self-regulation. Perhaps the most far-reaching change made by Congress in setting up the PCAOB was to include in the statute an explicit mission to act in the interests of investors and the public. In setting standards, conducting inspections, and imposing disciplinary sanctions, the explicit objective was and is to act in the public interest." Close the quote. After SOX, India went through the 2006 amendment to the Chartered Accountants Act that established the QRB as the Quality Review Board as a purely recommendatory body. The Satyam matter of 2009 saw the enactment of Section 132 in the Companies Act 2013. The PNB scam saw the section being brought into force. Many countries all over the world have also set up IARs. There is also an international forum of IARs, which is known as IFIAR, which has 55 member country IARs as members. Membership of IFIAR is open to regulators that are both A, independent of the audit profession, and B, engaged in audit regulatory functions in the public interest. IFIAR has drafted and adopted 7 core principles that seek to promote effective independent audit oversight globally, thereby contributing to members' overriding objective of serving the public interest and enhancing investor protection by improving audit quality. These core principles are as follows. 1. The responsibilities and powers of audit regulators should serve the public interest and be clearly and objectively stated in legislation. The responsibilities and powers of audit regulators should, at a minimum, require independent oversight of the audits of public interest entities. 2. Audit regulators should be operationally independent. The audit regulator should be operationally independent from external political interference and from commercial or other sectoral interests in the exercise of its functions and powers, including not being controlled in its governance by audit practitioners. 3. Audit regulators should be transparent and accountable. These 3 core principles are grouped by IFIAR under structure. The remaining 4 core principles are grouped under operations. 4. Audit regulators should have comprehensive enforcement powers, which include the capability to ensure that their inspection findings or recommendations are appropriately addressed. These enforcement powers should include the ability to impose a range of sanctions, including, for example, fines and the removal of an audit license and/or registration. 5. Audit regulators should ensure that their staff is independent from the profession and should have sufficient staff of appropriate competence. 6. Audit regulators should be objective, free from conflicts of interest, and maintain appropriate confidentiality arrangements. 7. Audit regulators should make appropriate arrangements for cooperation with other audit regulators and, where relevant, other third parties. Though stated in terms of audit regulation, these principles apply equally to a financial reporting regulator such as the NFRA. Now, let me tell you something about what we have been able to achieve in these initial 3 years. We have gone through a series of teething troubles, as is only to be expected when a new organization like this is set up. NFRA has defined its objective as the continuous improvement of the quality of corporate financial reporting in India. As I mentioned earlier, this objective is derived directly from both the Act and the rules. Thus, NFRA's objective is not limited to only audit quality. NFRA has therefore designed its work program to focus on this objective. Rules 7 to 9 of the rules specifically require the authority to monitor and enforce compliance with accounting standards and auditing standards and oversee the quality of audit services. These rules also lay down the processes by which such functions are to be carried out. The inspection program that NFRA has instituted pursuant to the above has 2 components. The components are: 1. The financial reporting quality reviews are FRQR for short, and the audit quality reviews are AQR for short. Financial statements are presented as an integral part of the annual report of the company. The annual report has many interlinkages amongst its constituent parts. NFRA's primary role, as explained in Rule 4 of the NFRA rules, is to protect the public interest and the interests of creditors, investors, and others associated with companies or bodies corporate. The annual report is the mechanism through which all the information required by these stakeholders is sought to be provided. The primary objective of the FRQR is to assess and evaluate how well the information needs of these stakeholders has been met. In undertaking the FRQR, NFRA's role also includes monitoring compliance with accounting standards. The FRQR focuses on the role of preparers, that is, those responsible for the preparation of financial statements and reports in accordance with the applicable accounting standards. Therefore, the FRQR evaluates how well the Chief Financial Officer and the rest of management and the audit committee, as well as the board of directors of the company, have performed in preparing financial statements that show a true and fair view as required under the Companies Act and in accordance with the applicable accounting standards. The FRQR concludes with an advisory to the preparers highlighting the matters that need improvement. In case there are violations of accounting standards and the law that require action to be taken under the law, the matter is reported to the authorities who can take action. The AQR, on the other hand, has the objective of verifying compliance by the audit firm with the requirements and the standards on auditing relevant to the performance of the engagement. The AQR also has the objective of assessing the quality control system of the audit firm and the extent to which the same has been complied with in the performance of the engagement. NFRA's AQR process starts by asking the audit firm to provide to NFRA the audit file. Thereafter, the audit firm is issued a questionnaire. Once the audit firm provides its response to the questionnaire, the matters raised in the questionnaire are examined by referring to the relevant portion of the audit file as identified by the audit firm. Subsequently, NFRA conveys its prima facie observations, comments, conclusions on the various issues in the questionnaire to the audit firm. The audit firm's responses to NFRA's prima facie observations are examined, and a draft audit quality review report is then issued. The audit firm submits its written reply in response to the draft. This is followed by a presentation to NFRA if the audit firm so desires. After considering all the submissions made by the audit firm, NFRA completes its review and publishes the final report as mandated by law. Section 132 of the Act empowers NFRA to take action against auditors for professional misconduct. However, as far as other functionaries of the company who have a responsibility for financial reporting are concerned, penal powers continue to be vested with the central government. This is so as regards even matters such as unacceptable delays in filing periodical returns with NFRA. To enhance the effectiveness of the implementation of the law, it is necessary to consolidate all the necessary penal provisions relating to financial reporting and to vest them in the NFRA. This will allow for integrated regulation of all the participants in the financial reporting system. NFRA's AQR activity thus far has been dictated by the cases that have led to major financial scams recently. Going forward, NFRA proposes to adopt a risk-based approach for the selection of companies. This has been outlined in NFRA's conclusions on its recent consultation. The factors that will be considered in this process will be grouped into two categories: external impact factors, which will be one category, and the risk of material misstatement or ROM factors. External impact factors will cover all metrics that seek to understand, identify, and measure the financial impact that a company has on the economy and the environment. ROM factors will identify metrics that can potentially predict the ROM that may escape either the attention of auditors or could be overlooked by auditors. In respect of each of these two broad categories of indicators, companies would be classified into one of three buckets based on substantial, moderate, and low external impact in terms of the external impact factors, and high, moderate, and average ROM. Once the comprehensive list of metrics and their calculation methodology are detailed, a suitable method for calculating the composite index of the metrics under each category and the ranges for each of the three buckets under each category will have to be developed. The result of the above classification would be a 3x3 matrix. NFRA will give the highest priority to companies which are in the high ROMM, substantial external impact cell, whereas companies which are in the average ROMM or low external impact cell would normally not be subject to detailed inquiry unless the resource position of NFRA so permits. The selection criteria of companies and audits for inspection will also include random methods of selection so as to ensure that appropriate responses are possible to emerging situations. NFRA is conscious of the need for transparency in the approach to inspection. However, NFRA is also to consider any unintended consequences that could follow upon complete and detailed disclosure of the risk-based methodology in terms of the potential risk of loss of the element of surprise. This could prove detrimental to the effective discharge of NFRA's functions and duties. Therefore, NFRA will disclose only the high-level principles of its inspections approach. NFRA has so far published 4 audit quality review reports. Some more are in progress. 3 disciplinary orders have also been finalized. NFRA has also forwarded 1 report to government for action against functionaries other than auditors. What these reports and orders have done is to clearly enunciate what NFRA will look at when it examines audit quality and in what manner. They also clarify the scope available under the law for the provision of non-audit services by the statutory auditor and the understanding of terms such as professional misconduct, gross negligence, lack of due diligence, etc., as applied to disciplinary proceedings under Section 132(4). In all these matters, we believe that NFRA has broken new ground. NFRA has explained why it would also be necessary for the courts to examine all these matters afresh. The jurisprudence on this subject is yet to evolve and get stabilized. One reason is the paucity of case law. The other and more important reason is the vast change in the context and rationale for audit regulation that has happened in the years since Enron. We are not yet at a point where the higher judiciary has started engaging itself with these issues. Nevertheless, NFRA is confident that the approach it has adopted is robust enough to withstand critical judicial scrutiny. I will now move on to what I have to say about standards and the standard setting framework. NFRA measures the quality of corporate financial reporting essentially by its compliance with the law and the statutorily notified accounting standards and auditing standards. Attempts by various regulators to reduce audit quality to a single numerical index have not so far been successful. Regulators therefore use the extent of non-compliance with auditing standards as the measure of audit quality. The accounting and auditing standards in force in India are almost entirely the same as their global counterparts. Divergences from the global standards are minimal. As far as accounting standards are concerned, the finance minister announced in his 2014 budget speech that there is an urgent need to converge the current Indian accounting standards with the International Financial Reporting Standards, IFRS. I propose for adoption of the new Indian accounting standards, Ind AS, by the Indian companies from the financial year 2015-16 voluntarily and from the financial year 2016-17 on a mandatory basis. The coverage of Ind AS, which are converged with the IFRS, has progressively expanded. As far as the auditing standards go, the ICAI states that, and I quote, it is one of the membership obligations of the Institute to actively propagate the pronouncements of the International Auditing and Assurance Standards Board of the IFAC, to contribute towards global harmonization and acceptance of the standards issued by the IAASB. These standards adopted by the ICAI have now got statutory recognition. In a sense, it can be said that we have put the process of standard setting out of the scope of influence of domestic interest lobbies. There is also no gainsaying the fact, as NFRA's experience so far indicates, that compliance with these standards is likely to achieve a high quality of financial reporting. At the same time, we need to be aware of the influence of various international lobbies in the standard setting process. This seems to be well documented in the relevant academic literature. In his book titled Political Standards, Professor Karthik Ramanna, who is now at the Oxford University and was earlier with the Harvard Business School, describes the standard setting process as representing what he calls, within quotes, a thin political market. Such markets are, he says, by their very nature, one-sided and unrestrained vis-a-vis the general interest. He goes on to say, and I quote, accounting rules cannot be determined without the substantive expertise and experience of special interest groups that, by definition, also have strong commercial interests in the outcome and enjoy little political opposition from the general interest because of the abstruse nature of the subject matter. Close the quote. Based on extensive research on the standard setting process in the US and with the IFRS, Ramanna concludes as follows, and I quote, in several instances, I find evidence of rules that benefit one or more special interest groups, for example, industrial corporations, financial firms, and audit firms, at the potential expense of the general interest. In other words, the evidence suggests special interest capture of the accounting rule-making process. But unlike the traditional understanding of capture, where powerful interest groups are able to strong-arm regulators to obtain rules in their favor, several instances of capture in accounting rule-making are more subtle. Close quote. Sometimes, even governments seem to swing into action. Ramanna recounts at length how China was able to force a significant dilution in the disclosures of related party transactions in the case of state-owned enterprises because of the need to get their financial statements accepted in global anti-dumping investigations. Ramanna also describes Tata Steel's role in the introduction of para 46 in AS11. Given the fact that we have adopted global standards almost completely, our attempt must be to enhance our participation and increase our voice in the standard setting process. If we were to look at the period from 2011 onwards till June 2021, there were a total of 186 completed IFRS projects. Indian bodies had commented in 102 cases. Of these, ICAI had commented on 70, SEBI on 62, and other agencies and a few individual companies on 10. As far as auditing standards go, the ICAI has participated in the consultation on one standard out of 11 in the same period. Our focus on Ind ASs would benefit from hard data about the actual coverage of these standards. As of 31st March 2021, MCA reported 12,99,710 registered companies, a trifle short of 13 lakhs. Of these, 65,942 were public limited companies, 36,524 were one-person companies, and 11,97,244 were private limited companies. Ind ASs apply to all listed companies and companies with a net worth of rupees 250 crores or more. According to MCA 21 statistics as of 31st March 2019, only 3,568 companies in India, 3,568 companies in India with net worth exceeding rupees 250 crores had filed their returns till June 2021. Of these, 2,939 had filed under Ind AS. On the other hand, 14,581 companies with net worth below rupees 250 crores have also filed under Ind AS. The initial understanding is that these companies below rupees 250 crores net worth have filed under Ind AS because they are listed or they are subsidiaries, associates, etc. of companies covered by Ind AS. This would seem to indicate that we need to examine if Ind AS-based accounting and auditing is the best way to go in respect of all companies. There is a very large segment of corporate entities for whom appropriate accounting and auditing standards need to be framed. This should prove a fertile area for coordinated research between academics, professionals, and regulators. NFRA also needs to consider standard setting as a core activity and build up expertise so as to effectively promote the public interest. I now come to this issue of independent standalone audit as a viable business model. Starting with Enron, the deleterious impact of the provision of non-audit services on the independence of the auditor has been well documented. Arthur Andersen's conflicts of interest leading to loss of independence were significant. It is said that Arthur Andersen was accused of applying lax standards in its audit because of a conflict of interest over the significant consulting fees generated by Enron. During 2000, Arthur Andersen earned $25 million in audit fees and $27 million in consulting fees. Professors Healy and Palepu of the Harvard Business School say that, and I quote, whether the auditors at Andersen had conflicted incentives or whether they lacked the expertise to evaluate financial complexities adequately, they failed to exercise sound business judgment in reviewing transactions that were clearly designed for financial reporting rather than business purposes. When the credit risks at the special purpose entities became clear, requiring Enron to take a write down, the auditors apparently succumbed to pressure from Enron's management and permitted the company to defer recognizing the charges. Internal controls designed to protect against conflicted incentives of local partners, internal controls at Andersen, designed to protect against conflicted incentives of local partners, failed. According to an UNCTAD paper, and I quote, both the Powers Committee and the bodies of the United States Senate, which have investigated Enron's collapse, have taken the view that lack of independence linked to its multiple consultancy roles was a crucial factor in Andersen's failure to fulfill its obligations as Enron's external auditor. Mark Stevens, in his book called The Big Six, The Selling Out of America's Top Accounting Firms, which was published in 1991, traces the origin of the growth in importance of non-audit services to the competitive pressures of the 1980s. Amongst the big eight, he says, client companies could perceive no significant difference. And apparently the situation has not changed even now. In the more recent words of John Kingman, and I quote, certainly among the big four, audit services are frankly often much of muchness. Hence, clients were interested in CPAs who could serve as business advisors. Anderson proved itself early to be the smartest, most aggressive player in the new consulting game. The National Commission on Fraudulent Financial Reporting in the US, known as the Treadway Commission, reporting in 1987 had said that, and I quote, the tone that the top managements of public accounting firms set is just as important in the firms as that set by top managements in public companies. Many public accounting firms are large organizations in which personnel face institutional and individual pressures, not unlike those of personnel of public companies. In public companies, such pressures have the potential to contribute to fraudulent financial reporting. In both large and small public accounting firms, these pressures have the potential to compromise the skepticism and professional judgment that are critical to audit quality and the detection of fraudulent financial reporting. They also referred specifically to fee and budget pressures and said that, and again I quote, intense competition amongst accounting firms contributes to significant pressure on audit fees, often with corresponding pressure to reduce staff, time budgets, and partner involvement in audit engagements. Such pressures may not be conducive to the thorough investigation of red flags indicating the potential for fraudulent financial reporting or to the thorough exercise of professional judgment and skepticism. Close. Reading all this at the present time, the overwhelming feeling that I get is that we seem to have been there several times before. And yet, not much appears to have really changed. The Treadway Commission, however, did not recommend the two measures that have since come to be recognized as central to curbing the incentives to go along with managements in fraudulent financial reporting. These are the elimination of self-regulation of the audit profession and the ban on provision of non-audit services. It, however, noted the public obligation of the independent public accountant who audits the accounts of public companies. The United States Supreme Court, in its 1984 decision in the case of United States versus Arthur Young, had held that, and I quote, an independent certified public accountant performs a different role from an attorney whose duty as his client's confidential advisor and advocate is to present the client's case in the most favorable possible light. On the other hand, it goes on to say, the Supreme Court, in certifying the public reports that depict a corporation's financial status, the accountant performs a public responsibility transcending any employment relationship with the client and owes allegiance to the corporation's creditors and stockholders as well as to the investing public. I think it bears rereading. This last sentence in the extract from the US Supreme Court's decision. In certifying the public reports that depict a corporation's financial status, the accountant performs a public responsibility transcending any employment relationship with the client and owes allegiance to the corporation's creditors and stockholders as well as to the investing public. The foundation of good audit quality clearly is independence. The guidance note on the independence of auditors issued by the ICAI admirably summarizes what this means in practice. The Companies Act 2013 has built in several provisions to give statutory backbone to the lofty idealism of the guidance note. Section 144 lists several categories of non-audit services that a statutory auditor is prohibited from providing. Section 141(3) prohibits auditors with subsisting business relationships from being appointed as auditors or continuing as such if any such assignments are taken up. Section 144 prohibits these non-audit services from being provided either directly or indirectly. The explanation to Section 144 gives a comprehensive meaning to the word indirectly, saying that the provision of prohibited services by any one of 5 modalities would attract the ban. In a sense, India has already built into law the separation of an audit and non-audit services that other countries are only now attempting to achieve. For example, the UK FRC, after having waited futilely for the government to make the necessary changes in the law, has issued a 22-point action plan for the Big Four to operationally separate their auditing units. They have been given 4 years to actually put this into effect. This FRC edict has been described by the Financial Times as marking the largest shakeup of the industry in decades. The FRC's plan seeks to ensure that firms pay auditors in line with the profits of their audits, ring-fence the finances of the audit division with a separate profit and loss account, and introduce an independent audit board to oversee this practice. The questions that are left to be resolved are whether such an independent standalone audit conducted in full compliance with the prescribed standard is likely to be a viable business model at current rates of auditors' fees. And if not, which is my understanding of the situation, what can and should be done in the light of the valuable public good nature of independent audit. Certainly, an audit conducted rigorously in compliance with the standards is not something that would be considered as value additive by managements. The reluctance on the part of management to spend anything more than the absolute minimum on this activity is understandable. On the other hand, the apathy towards good quality financial reporting amongst user groups is a great dampener. So John Kingman proposes that the auditor be appointed and his fee fixed by an independent body representing the public interest. He identifies the restructured audit regulator as the body for doing this. I do not agree with this recommendation. A regulator who appoints an auditor cannot sit in judgment on the performance of the very same auditor. I am sure industry and the profession will get together to provide satisfactory answers. To provide some perspective, I will share some data about this matter. Our standard cost estimate for a proper statutory audit in accordance with the auditing standards is around rupees 1.5 lakhs, even assuming a very small company and an audit firm in a tier 3 town location. We examined the audit fees paid by a sample of 3,91,021 unlisted companies who have filed data of the audit fees paid. Around 30% of them paid less than rupees 10,000 as audit fees, and another 30% paid between 10,000 and 25,000. It is hard to believe that any CA would sign an auditor's report that carries significant professional and legal responsibilities for such low amounts, unless, of course, there is virtually zero likelihood of being held liable for bad work. I now move on to the financial reporting ecosystem. I wish to talk specifically about two important components of this ecosystem. They are the judicial system, which is one, and the second, which is the investor or user community. One suggestion made by several respondents to NFRA's recent consultation paper is that NFRA should introduce a settlement mechanism. SEBI's example is also given in this regard. One obvious difficulty is that the law does not now provide for such a mechanism for NFRA. Even in the case of SEBI, the jury is out on whether the existence of legal banking has made for any great effectiveness of the settlement system. The answer to be found, I think, is in the speed and effectiveness of the judicial system. For reasons known to everyone, cases in our courts take a long period of time to reach finality. The incentive to accept a settlement offer is directly proportional to the speed and rigor of the judicial process. It is here that the US system seems to score much better. Even such a person as Rajat Gupta found himself in jail within a very short period after proceedings had started against him. This system-generated pressure is clearly reflected in the enforcement orders of the PCAOB. Out of 357 orders passed from 2003 to 2021, 310 were settlement orders and only 47 were adjudicated orders. The contrast could not be starker than in the case of Satyam. Satyam's auditors were quick to settle with the PCAOB. The scandal broke out in January 2009. PCAOB launched a formal investigation soon after. The auditor settled with the PCAOB, accepting the penalties and paying a fine of US dollars 1.5 million in April 2001. On the same day, the auditors also accepted the SEC's cease and desist orders and paid a penalty of $6 million. In addition, PwC India and PwC International agreed to settle a shareholder class action suit in April 2011 by paying $25.5 million. As far as my information goes, the matter has however not yet reached finality in India. The apathy of the investor or user community seems to be a problem even in countries like the UK. The US has traditionally been known as a society with a high propensity to litigate. The potential liability arising out of certifying misleading financial statements has been identified as a source of the pressure for high audit quality. Professor Suraj Srinivasan of the Harvard Business School explains the matter in the following words, and I quote, "Auditors' incentive to do a good job is to maintain their reputation. The complement to reputational incentives is the litigation system. The US is somewhat unique in having a strong class action litigation system through which investors can hold companies accountable after the fact when there is a problem. For investors, this is how they can partly remedy the harm." Close. But even in the US, recent research has shown that lawsuits against auditors for accounting violations have fallen over the past 20 years. The researchers, of whom Professor Srinivasan is one, attribute this to two decisions of the US Supreme Court in 2007 and 2011 that effectively narrowed liability standards by requiring plaintiffs such as institutional investors to prove that auditors knew or should have known that their clients' financial statements contained errors. The Companies Act 2013 has introduced a provision for members or depositors of a company to claim damages or compensation from the auditor for any improper or misleading statement of particulars made in his audit report, or for any fraudulent, unlawful, or wrongful act or conduct. 245(1)(g) small Roman 2. We are yet to see the results of action either under this section or under section 447. I now come to the capacity building of the NFRA. NFRA now operates on the basis of a single section in the Companies Act 2013. This section does not provide a comprehensive coverage of all the functions and powers that are required to constitute the NFRA as a corporate financial reporting regulator. Besides, the statute treats the NFRA essentially as a subordinate office of the Ministry of Corporate Affairs, with only such administrative and financial powers as the ministry may choose to delegate. In the interest of the functional, financial, and administrative autonomy of the NFRA, there is a compelling need for a standalone legislation. This will be the key to build up the regulatory capacity of the NFRA. The Technical Advisory Committee of the NFRA has been entrusted with the task of developing a draft law. I now come to my last topic, which is the future of accounting and audit. In a significant measure, audit will continue to follow accounting, which in turn should follow developments in business and industry. Given the diversity amongst corporate entities in the country, it appears to me that it would be more appropriate to speak instead about the several futures of accounting and audit. At one end, we have companies at the cutting edge of technology and innovation, funded largely by the early stages of venture capital. Every day, we hear of one or the other company having achieved unicorn status. At the other end, we have a huge number of companies whose turnover, profits, and market cap in the case of listed companies are very small in absolute terms. Questions that would naturally arise, seeing this diversity, are whether uniform accounting and auditing standards are the way to go, and even whether compulsory statutory audit of general purpose financial statements is desirable in the case of the vast majority of companies who do not seem to be able to afford the same. These companies, which would be largely micro, small, and medium enterprises, are essentially family-owned enterprises formed as companies for the sake of limited liability or to get bank loans, bus route permits, mining licenses, and the like. They are effectively glorified proprietorships or partnerships. There is no public interest involved in foisting external audit on them. In any event, it is clear that such audit as is being carried out cannot boast of any quality at all. Banks can direct them to have an audit as a condition for giving them loans, but that would be a private matter. Exempting small companies from mandatory audit would result in furthering the ease of doing business for MSMEs and reducing the compliance burden and costs on such enterprises. A recent example is the increase in the turnover threshold for mandatory tax audit from rupees 5 crores to rupees 10 crores in the Finance Act 2021. Similar considerations would seem to apply in the case of most small cap listed companies also. Perhaps the minimum eligibility criteria for stock exchange listing have also got to be reviewed. As far as high-tech companies go at the other end, there is the view of Professors Baruch Lev and Feng Gu, backed by extensive research, that the poor quality of even honest, within quotes, financial reports legitimately disclosed under the current universally used accounting system seriously harms capital allocation and economic growth. Lev and Feng conclude that corporate quarterly and annual reports contribute only 5 to 6% of the total information used by investors. They say that what is instead required is a strategic resources and consequences report that would overcome the three causes for the loss of relevance of accounting. These causes, according to them, are the accounting for intangibles in a manner that does not reflect their real importance, the piling up of estimates in the financial statements, and the non-recording of the events that affect corporate value, given that accounting operates only if there are transactions between entities. There is much in what they say that should stimulate thinking, not the least of which would be the role, methodology, and significance of accounting and auditing as traditionally understood in the case of these companies. In any discussion on the future of audit, it is de rigueur to speak of blockchain, AI, machine learning, ESG, etc. I will not go there because there are others who are better experts at this than me. To sum up, company financial statements and their audit are examples of regulation of companies. The design of this regulation has to be clear about its objectives. It has to be grounded in precise data about the regulated entities and their characteristics, and differentiated in a manner that acknowledges their heterogeneity. At every stage, the design of regulation has to be conscious of available regulatory capacity and the real cost thereof versus the hoped for benefits. Given some of the facts described above, it would appear that there is great need and scope for serious examination of the present system. As far as NFRA itself is concerned, our focus will be clearly concentrated in the manner described above in detail on companies with the greatest external impact. Our aim will be to create conditions that would reassure those who have to deal with such companies about the basic reliability of their financial statements. Thank you.
Thank you very much, sir. That was a wonderful insight that you have provided of the 3 years that NFRA has been active. I'll just pull out 2 or 3 things that struck me as the key messages that you want to leave behind with us. One is the examination of who should be audited and with what rigor. That seemed to be an important takeaway and a stimulating discussion that we need to have in the profession. The whole idea of external impact oriented companies, which need to be focused on, I think was a very big part of what you said. The idea of judgment processes like intangibles valuation and estimates, which drive financial statements, also give a huge room for all of us to think about. And the idea of red flags and pursuing them now seems to be part of the way that industry is actually implementing from public data that is put out by Ministry of Corporate Affairs, by the courts of the law, and everywhere. Wherever there is a public registry, there seems to be an access to it which is available, which would help the red flagging. And strewn across your wonderful address were many other gems of thought, which we will all discuss and debate for many years to come. So, very thankful to you for such a comprehensive, well researched, and stimulating address. With that, we now move into speaking about what we see as three people who have been in the profession. I have, of course, stepped out of the profession 2 years ago, but I still am extremely engaged with auditors, both Pricewaterhouse and Deloitte, who are represented by Harinderjit and P.R. Ramesh. I have very significant interactions from in terms of my perch on the audit committees of the companies that I serve on. But let me begin by sharing, sir, with you what we believe is the future of accounting. And I take all of you 10 years into the future. And I will spend just 5 minutes to craft my vision of how we will be performing auditing. And as you rightly pointed out, accounting precedes auditing. My vision is that blockchain, which you mentioned in passing, will become ubiquitous because the pillars that we will hang our hat on, we will need to hang our hat on, is non-hackability of the data systems through which internal and external data actually moves. And the only way to assure that is by creating a fully digitized, automated, quantum computing driven paradigm, which will move the onus of the routine accounting processes to the source of the data, which is the banking system. Every transaction passes through the banking system, and every security gets registered with a depository participant and with a depository. And what we believe is that these two will become the clear sources of providing accurate information which is non-hackable and which is clearly relatable to the entity to which the accounting actually happens. And we also see that for the judgment processes, which you described so eloquently, the intangibles and the estimations, we will need algorithms which will multiplex the internal data with the external data because both data are streaming. And it has become the remit of all of us who are minding the accounting systems of companies to make sure that both the internal flows and the external flows are adequately matched in a way that the input to the ultimate report will be accurate and will be meaningful to people who will use those financial statements. I'm going to leave it to Harinderjit to talk about ESG, another subject that you referred to. But in terms of technology, I also see, in terms of the evolution for the future, a complete digitization of the process by which the entire financial system is overseen. And I can sense that once the blockchain gets ubiquitous and it is possible for entities to represent physical reality by digital means, which today we talk about as NFTs. And if a whole system of tokens is so assigned that the producer of the value, the consumer of the value, and everybody in the ecosystem, which is part of the governance mechanism, would have appropriate tokens which represent their interest, then we would be in a position to secure for the world a decentralized, democratized, low cost, very effective source of governance, where on every aspect, where there is a fork in decision making, the owners of the governance tokens would have an automated right to vote on it. And therefore, the regulation that you are responsible for, sir, would be in a position to oversee this entire interaction between the digital and the physical world, between economic, political, social, and other forces that are at play in the interaction in the economy, and therefore create a fully trustworthy and completely up to date system of providing insightful information, much like what you talked about in the research paper that you referred to, which talk about resources. And here I divide resources into two parts in my mind. One is the resources which are the commons, which all of us need to enjoy together: the air, the water, the atmosphere that we live in, the cleanliness, the sense that we feel of walking into a space that we enjoy. All of this, to my mind, are the commons and many others. And then there is what is inside an organization, which is the physical reality, the intangibles, the brands, the innovation capital, and all of those. Both of these will need to be tracked in terms of how, by the actions that the economic entity is performing, are getting affected. And through a symbiotic regulatory and preparation mechanism, we would be able to make sure that the outcomes from such a system are completely reliable and timely. And I personally am pushing wherever I can. In fact, even this morning before this seminar, I had a full 1 hour discussion with a set of youngsters who have similar ideas and are actually automating some of these processes. And it seems to me that this future is catching on much faster than all of us expect. So we will soon have, sir, three constructs: an ERP for ESG. So we will have uh, a system which will ensure that data sets are tracked and it is not dependent on data entry, which is the chief cause for anything going wrong and any accounting entry being made which is fraudulent or is misrepresentative of the facts. Two, we will have what I like to call the Netflix of outcomes. And so every entity will be able to demonstrate what they have done and accomplished through a pictorial or a videographic representation of what outcomes they have delivered. And three, I can sense the need for a TEDx of communication, both internally driven, externally driven, to make sure that boards, the C-suite of executives who are preparers, auditors, regulators such as yourselves, people in government and all can communicate in a way that the end objective of creating and raising the trust of society in the information that they are consuming to make decisions is enhanced and keeps getting enhanced and reassured as we move forward. Thank you very much to CII for organizing this extraordinary conference. And thank you, Mr. Rangachari, for the brilliant address you gave. May I now call upon Mr. P.R. Ramesh to make his observations, and then we will get Harinderjit to talk about ESG at the end. Ramesh, over to you.
Thank you, Shailesh Bhai. Chairman NFRA, Shailesh, the moderator, my fellow panelists, Harinder, ladies and gentlemen. I'm really privileged to be here and thank you for this opportunity. But before I begin, I must correct Shailesh Bhai. I'm not here representing Deloitte. I too have stepped out of the profession 18 months ago, and never in a forum like this do I reflect the views of an organization where I'm appearing as a professional. So pardon me and bear with me. I'm reading from a prepared text, which I normally do not do in the interests of time. A lot of it has been said by the chairperson, a very comprehensive speech, and I'm grateful to him for his very valuable insights. He's always walked the talk by carrying out some very intense and thorough AQRs in a fair and unbiased manner. And Shailesh Bhai, a great big thanks to you for laying a solid foundation on the session of the future of auditing and also accounting you mentioned about, and your views on impact of technology on the future of audit. In this short period of 10 minutes, I will try and give a perspective on the future of auditing as I see it. I can only be brief and raise a few points, as this subject requires a lot of time for a comprehensive discussion. Prophetically, perhaps, the session uses the title Future of Auditing rather than Auditing in the Future, implying the bleak future for audit if carried out as is being done presently. None of us can predict the future, as we do not possess the proverbial crystal ball or tarot cards. We can imagine the future by understanding the present situation, that is the current state, analyze the trends, challenges, headwinds, and tailwinds, evaluate and consider the impact of external and internal factors. As Professor Karthik Ramanna, whom the chairman also quoted, as he said, quote, auditing today faces a crisis of trust, an especially perverse situation given the audit's central role in fostering trusts in markets. The depth of public distrust in auditing is connected to the wider public disillusionment in capitalism. To many, the capital market system is no longer seen as an enabling economic mobility, but rather as an insider's club that enriches wealthy shareholders and their intermediaries, which are corporate management, bankers, and worrisomely, auditors at the expense of ordinary savers, employees, and citizens. Whether this perception is even substantially supported in empirical fact is somewhat irrelevant, because the perception has eroded trust in markets, and trust is, of course, what makes markets work, unquote. Sir Donald Brydon, in his review report, stated, I quote, the quality and effectiveness of audit has become an increasingly contested issue. Audit is broken, but it has not lost its way, and all the actors in the audit process bear some measure of responsibility, unquote. These statements correctly reflect the state of the auditing function presently. This state is true not only of UK, but also India and the rest of the world. What then are the causes? What should be done to fix it? What is the future? I will not spend time on the causes, which is largely the profession's own making, but will instead provide some thoughts on how to fix it. The future of auditing, as I mentioned already, if done the way it presently is indeed bleak, more particularly given the developments in technology and other changes in regulations, headwinds, etc. Let me again quote Professor Karthik Ramanna, who rightly said, restoring public faith in auditing will require action from many players, including investors, client boards, management, regulators, the media, and civil society. But above all, It will require action from the audit firms themselves. Trust, unquote. Trust me, the action is not simple and easy. Far too often we have done some minor changes, example, dealing with rotation, dealing with independence rules, changes in supervision mechanism, Sarbanes-Oxley, etc., which at best, in my view, have had a placebo effect, leading us to the present state of concern. I'm reminded of a situation 40 years ago when I was a young man and driving my first car. At that time, we had just about two choices in automobile industry. And those companies would produce different models, call them Mark 1, Mark 2, Mark 3, Mark 4, with changes in grille, headlamp, wiper, no substantial changes. And we all were left with the feeling that every new model was a substantial improvement over the past. But that was not so. Those two companies do not exist today. And this will happen to the profession if we do cosmetic changes. Please don't mistake me. I have been one amongst you for more than 4 decades and have witnessed the decay. This is not to say that there are no good audits or no good auditors. Increasingly, these are heading towards becoming either rare events or rare persons. Let me come back to what needs to be done. We need to address and change the why and what of audit, the who does the audit, how is audit done, and finally, the output of audit. We will need to address the perception of audit quality as well as the substance of audit quality. To succeed, this requires, and this is the most difficult thing, willingness to accept the present, introspect and identify root causes, identify possible actions with end state being clearly visualized, willingness to transform, and above all, the ability to implement and swiftly embrace change. I will classify my suggestions into 7 buckets. First, purpose. The second, the structural factors. The third, environmental factors. The fourth is the execution of audit. Fifth, the output factors. Sixth, oversight and evaluation. And lastly, the seventh, other factors, which is frequency, timelines, transparency, etc., and also the coverage, whether small companies need to. I will not speak about, in the interest of time, on structural factors, which is profile of the profession, audit market, choice and concentration, size of firms, appointment, compensation, multidisciplinary firms, etc. Or environmental factors such as ecosystem, internal audit, role of audit committees, etc. Or the oversight, which Mr. Sridharan has very eloquently spoken about, and other factors, which is about need for audit for small and medium enterprises. Let me begin with purpose. Too long has the audit profession taken shelter behind the words true and fair. At the auditing standards, which it wrote for itself and about which the users have little knowledge about. Any extra asks by the users was rebuffed and rationalized as expectation gap. If this rationalization were to continue, the gap would only widen so much that the audit profession and its users would be so far apart that the need for audit services would become irrelevant. If the expectation is to address fraud, the profession must take steps. If the expectation is to provide some form of assurance of the future of the entity, the auditor, who is the expert, should be willing to advance a few steps in this direction. I will now briefly touch upon who does the audit and how audit should be done. I believe the current model is flawed. Audit is significantly done by trainees or fresh graduates. To expect them to discover frauds or interpret visible signs of misreporting or failure is similar to a medical student carrying out a surgery and the busy, eminent surgeon coming in at the end when the sutures are to be done. Our experienced and qualified auditors spend disproportionately less time compared to that of the trainees. I believe articleship with specific focus on specialization should begin only after passing CA exams. Having briefly dealt with who does the audit, I will touch upon the how of the audit. Audit has over years moved away from a thinking audit to an inking audit. The focus has shifted to documenting the processes rather than effectively carrying them out. Auditors have lost the sense of smell. The focus on testing and reliance of internal controls through walkthroughs, etc., has diluted the effectiveness of audit. There is more emphasis on correctness of accounting and disclosures than the proprietary and genuineness of the transactions. With this, the auditors seem to be at the threat of losing their sight too, in addition to their sense of smell. Sampling methods, however scientific, dilute audit quality. With use of technology, it is today possible to scan the entire population, focus on outliers, identify questionable patterns, etc. It is time the auditing standards on audit sampling is revised and the profession embraces the approach of covering a larger part of the population, given the advent of technology. Yet another issue is the focus of audit. The audit today is about verifying what is presented rather than confirming expectations. Very few auditors walk into a client knowing or what they should expect. Instead, they go about verifying what is given to them. I think the profession, with all the tools in its possession, should be in a position to be able to predict a result rather than verify a given result. It is also about, as Sherlock Holmes said, the dog that did not bark. This is what auditors should start building skills about. I personally believe, now let me come to the close by touching upon one more item, which is the output factor, the auditor's report. I personally believe sunshine is the best disinfectant. Over years, I have witnessed the profession resisting changes to the bland, template-driven audit report. Even the significant resistance to CARO 2020 is a classic example. This is strange, considering that the only visible part of the audit to the users is the audit report. And if anything can influence perception of audit quality, it is the audit report. Most audit reports are similar, if not identical, barring minor differences due to the recent inclusion of key audit matters. Does this mean audit quality in all cases is uniform? It is time we brought out into the open information on what and how the auditor has done, by whom, what did he find, how many professionals he deployed, what time did they spend, rather than the bland statement that the audit has been done in accordance with the auditing standards. So today, as I see it, if you're talking of audit quality, two reports, one an auditor has done without doing, signed off without doing any work, another by doing a very thorough audit, both read the same. This is what is visible to the user. Isn't it time we address this output factor too? I will end with this. In the interest of time, there is a lot, but all I can say is unless we are willing to transform, not do cosmetic changes, and be bold in it and address all components of what the way we are doing currently, we will still be continuing to carry on in a slightly better way perhaps, and the future of auditing will definitely be bleak. Pardon me if I have been harsh, but
No,
I know I'm not going to be in the future, but I hope this will be a good lesson for those who are going to be auditing in the future.
It is fantastic. So telling, Ramesh. Thank you for your boldness, your clarity, and your complete openness in sharing your deep thoughts. Thank you very much. Harinder, now it's up to you to talk about 6 capitals instead of only the financial capital.
Good afternoon, Shailesh. By last man standing to close this, and I have exactly 6 minutes that's left. Right? Let me see what I can do in those six minutes. I'm here to give a brief perspective on the development in corporate reporting in a very summarized way, and these views are purely mine as a professional. After years of debate relating to relevance and reliability of future of corporate reporting with corresponding impact on auditing, the time has come to change the corporate reporting by disclosing reliable, relevant, and robust non-financial matrices along with financial reporting. And following factors are driving this change in corporate reporting. These are mega trends in changing in climates, resource scarcity, large scale urbanization, technology development, societal expectations have impacted the sustainability of the companies. The big picture needs to be told to the stakeholder and not the shareholders alone, along with financial reportings, which can be independently audited. The question the stakeholders are asking to the companies, how are you making profits rather than how much, and how their business model will be compatible to zero waste economy, net zero economy. Global net zero commitment have doubled in last 1 year. Businesses have started to realizing the tangible, physical, regulatory, brand and reputation, financial stability risk is there if they don't act now, impacting their access to capital and debt. Already Ps, VCs, banks, funds are looking for at investing in ESG compliant companies. On the regulatory front also, India is moving from voluntary to mandatory compliance of EASG. For example, the impact assessment of CSR and BSR SR for top 1,000 companies have been made mandatory. Other jurisdictions in US, EU, etc. have also come out with similar mandatory requirements. Interestingly, the survey carried out by IFI on reporting on sustainability across 22 jurisdictions, 1,400 companies, including 100 in India, across various industries, it appears a lot is happening in this space. For example, 91% companies reviewed had some level of sustainability information, and it was reported in the form of sustainability report, annual report, or integrated report. And 51% of such reports had some level of assurance, either a limited assurance or reasonable assurance. Multiple reporting frameworks, stroke standards used are GRI, SASBs, UN SDGs, TGFDs, and Integrated Reporting Council. The survey also highlighted lack of consistent standards, stroke framework for sustainability used and the audit of the same. And the company often has to deal with the question of which set of matrices, robust non-financial matrices, to which to we disclose, which are beyond the regulatory framework. Which matrices matters most to the company, and this is the guidance for the company. Which matrices matters most of the business to the stakeholders, and do the systems and in IT processes support those disclosures? Shall I refer to the ERP systems which will produce such non-financial information? Over last 18 months, significant process has happened towards globally consistent sustainability standard reporting standard, and the most promising is the expected launch of IRS foundation of ISSB. Other significant development is that major framework standard setting institutions are working together. Like IIRC and SSB have merged. In conclusion, I would like to say companies need to reinvent corporate reporting to meet investors, stakeholders' expectations. It's no more a PR exercise because stakeholders expect convincing evidence which can be audited. Standards and processes and internal controls for non-financial reporting will need to be as robust as the financial reporting. And then we need globally aligned standards to reliably drive consistency and trust. And my last point is the ESG information needs to be audited for trust, for which the firm need to upscale their resources and need SMEs to support them. Thank you very much.
Thank you very much, Harinder. I think, sir, you will notice through all three of our presentations the desire to change the quality, the reliability, and the trust in every piece of information that becomes available to investors, not only current, but future. And, sir, we will join hands with regulators and with the lawmakers to make sure that the trust in the reporting systems that all of us are so keen to make sure really represent the truth will be reestablished and enhanced. Thank you again for your very, very visionary address. And thank you, Ramesh and Harinder, for showing us the path boldly and for telling us that the past has to be given up and we need to move to a new future full of trust, full of technology, and full of sustainability. Thank you very much. Over again to Vikas to close the session.
Sure. Thank you, Chairman sir. Saying thank you will not be suffice here. Rather, we are all fortunate to listen to your most comprehensive, well-researched speech and your valuable insights. We articulated about future of audit and accounting, but if I may say that today history is being made, as I'm sure your speech will be remembered and referred to in the times to come for future guidance and roadmap towards betterment of the accounting and auditing practices being prevalent in the country. Thank you very much, sir, for your kind presence and for your entrance. To Mr. P.R. Ramesh, thank you very much for your very candid, as always, and if I may say, daring red alerts. There are lots of messages out there and lots of introspection to be made by the stakeholders. I'm sure they will seek guidance from what you have articulated. To Harinder Sarji, thank you for sharing your important points towards the betterment of the profession and practices of audit and accounting and your message on the ESG piece also. And of course, to Shailesh Bhai, as always, it's always been a pleasure to listen to you, and also for your highlighting the role and importance of technology, very rightly so, which will have really significant impact on the future of audit. So with these words, again, thank you very much, sir, and thank you to Mr. Ramesh, Harindra Sarji, and to Mr. Shailesh Bhakti for this very important and very educative session. So thank you very much for your time.
Thank you.
Thank you, sir. Thank you, sir.
Thank you.